Hello, and welcome to the Chapter 4 video lecture. In this lecture, we'll talk about Chapter 4. This will be the first part in the Chapter 4 lecture series. There'll be another part. I'll try to split these up for you a little bit so there's not quite as much material in each video. So Chapter 4, this is an income statement. We'll talk about the first part of it. There's 4 parts of this chapter, just talking about the kind of basics about the income statement, what's useful for, limitations, what's the quality of earnings, format of the income statement, and some irregular income items. And then there's other reporting issues. So in this lecture, we should get through the irregular items, reporting for irregular items. And then the next video lecture, we'll talk about the other reporting issues. All right, so some of this should be a recap, but otherwise there might be some new stuff here too. So let's get going. The first topic here is kind of what do we use the income statement for? Well, if you remember from our last set of lectures in Chapter 3, we want to find information that's decision useful. I guess that was Chapter 2, decision useful information. And what kind of information is decision useful? Well, usually it has something to do with assessing future cash flows or future performance and confirmatory value, right? Evaluating past performance. So what's the usefulness of the income statement? Well, it's exactly what we kind of talk about there. We're going to be able to evaluate past performance and predict future performance. And finally, it helps us to assess the risk or uncertainty in achieving future cash flows. So that's the general reason why we want to use the income statement for. It's all about performance and the riskiness of our cash flows. Some of the limitations, I think this can probably be said about a lot of the stuff in the financial statements, but companies have to admit things that they can't measure reliably. So, like we talked about, I think we talked about in class, how some of these long-term assets, we'd like to have them at fair value. We'd like to use fair value as the major type of measurement for all of the assets on our balance sheet, assets and liabilities, but a lot of times we can't measure it reliably. So changes in fair values are one thing that we can't measure reliably for some assets, and sometimes those are omitted from the income statement. There's other things we can't measure, things like the value of our employment, of our management team. How do we evaluate whether or not the value of our CEO to the company? If we could do that, that would also be something on the income statement. If there's an increase in the value, if he gets an MBA, that might be an increase to the value of our company. It might be something we might want to put on the income statement. But we can't really evaluate or reliably measure the value of these things. So there's lots of stuff that we can't measure reliably that doesn't get into the income statement. The next one there, we say income is affected by accounting methods employed. So there's lots of different choices in your accounting methods, and we'll talk about that in more detail. And management has, management has some motives, particularly to maximize their pay and report, income that's in line with expectations of analysts. And so, if management has these different motives, they might choose accounting methods that achieve those motives, and we might have distorted earnings. So we'll talk a little more about that when we talk about accounting quality. So income can be affected by the choice in accounting method. And then the third one there, income measure involves judgment. So again, management can inject their own judgment into some of the items on the income statement. Or people can just make mistakes. So a lot of these, like we talked about with adjusting entries, a lot of those adjusting entries are based on estimates. And estimates involve judgment, and they can be wrong. So that's a limitation of what we have in our income statement, a limitation of the financial reporting system. So I think those are kind of the main usefulness and limitation things we talk about here. The quality of earnings. we talk about the quality of earnings, there's a lot of research on companies that have higher quality earnings or lower quality earnings. One way to define the quality of earnings is that it's reduced if earnings management results in information that is less useful for predicting future earnings and cash flows. So the quality of earnings is how well does it predict future earnings and cash flow. And like we talked about just a little bit earlier, management has some reasons, can sometimes have personal reasons for wanting to manage earnings to maximize their take-home pay, their compensation, and that might damage the quality of earnings for predicting future earnings and cash flows. So this example is exactly that. Companies have incentives to manage income to meet or beat Wall Street expectations so that the market price of the stock increases and the value of stock options increase. So since executives are paid in a large part with stock and with stock options, they may manage income to maximize those things. So that's the quality of earnings as we talk about it. All right, so the single step income statement. In this, we just have two groupings: revenue and expense. Revenue minus expense equals net income. There's only one step here. You've probably seen something like this before. And here's an example of it. We just group all of our revenue in one grouping: sales, interest, revenue. Put it all in the same under revenues all together. All the expenses in the same area: cost of goods sold, advertising expense. We don't distinguish between operating and non-operating categories. So really a basic income statement, a single step income statement, is one way that companies put together their income statement. Probably less common compared to a multi-step income statement. Multi-step income statements, at least in my experience, are much more common. In this case, we're going to have an operating section where we have things that are related to the major operations of the company. So this would be sales. So, for example, sales and cost of goods sold. You'd show your gross profit. Sales minus cost of goods sold is your gross profit. Then you could subtract off these operating expenses. These are expenses related to your main line of business, like something like advertising expense, depreciation expense. And then you have income from operations. So this amount gives you some information about how well the company is doing with their main line of business. And then we have some non-operating items here, such as interest revenue, interest expense. So maybe the company has some loans, maybe they've lent some money out, but that's not their core business. Their core business is making some kind of product for people, but they do have some financial transactions too. They're not a bank, so interest revenue, interest expense are not part of their main operations. So these would go in the non-operating section. Another thing that might go in this non-operating section would be a gain on a sale of a building or something like that. So if you had some occasional gain, you're not in the business of buying and selling property, you just sold a factory or sold a warehouse somewhere and you had booked a gain, that would be in this non-operating section. And then the final part is income tax down here in a multi-step income statement. So, one thing to think about here is you're getting a little more information from the company. So what is my company really doing? How am I making money? Well, I'm making it from these processes here. I'm making $83,000 on our main business. And these other things might be more of one-off events. This interest revenue, interest expense might be a one-off money, one-off events. So you might not count on them in the future as being part of a company's income. All right, so we'll talk about more, multi-step income statement more. It's beneficial because you get a little more information about where money is coming from, where the income's coming from, but it also is subject to some more managerial manipulation. So that it's more subjective. So the company gets to pick what goes in this income from operations and what goes in other non-operating income. Okay, so those are the two types of income statements. You'll have to know how to do both types, and learning the multi-step I think is maybe more difficult because there's more parts to it. So spend some time. Make sure you can go through. Sales minus cost of goods sold equals gross profit, minus operating expense equals income from operation, minus other non-operating expenses or revenue equals income before taxes, minus income tax expense gets you net income. So knowing that whole process and being able to put together a multi-step income statement is going to be something that's going to be on tests. So, all right. So the irregular income items are the next part of this chapter. Generally, we have three categories of irregular items: unusual gains and losses, discontinued operations, and non-controlling interests. So we'll talk about each of those. Unusual gains and losses are material items that are unusual and or infrequent. So there are specific legal definitions for unusual and infrequent that come into play here. So these unusual gains and losses should be reported in a separate section just above income from continuing operations before income taxes, or income before taxes. So, this continuing operations assumes that there's a discontinued operation, but it could just be income before income taxes if there wasn't a discontinued. So we'll talk about discontinued operations in just a second. Okay, so these unusual items are just going to be reported here in the non-operating section, section 2 here. And that's kind of all we have to do. So some examples are write-downs of inventory. So if some of your inventory, an example I always use is Apple. They have iPhone 2s sitting around in a warehouse. They're probably not going to sell the iPhone 2 anymore. If it has less value, when you sell its inventory, we like to hold that at the lower of cost or value. If the value of that goes down below the cost, we have to reduce the value of that inventory and write it down. So, if you have these events where some of your inventory becomes obsolete, that's not a normal thing that happens to your company. Usually you sell all the inventory you have. If you have some that's become obsolete, we have to write it down. Unusual, that's an unusual loss usually, and that would be part of non-operating section of your income statement. You also might have restructuring charges. Restructuring charges occur when companies have they shut down. It's sort of a nice way to say we're shutting down some factories, we're firing people, we're downsizing, things like that. Restructuring is usually that's what that means. So those happen occasionally. It's unusual and typically infrequent. You don't want to have to make your company smaller, shut down factories, and do things like that. But it does happen, so that ends up as an unusual gain or loss. So these, one thing to keep in mind, these are not net of tax treatment. So net of tax treatment would be something that occurs below the income statement line. So you see here, for special item, for one item, discontinued operations, they get special below income tax, after tax treatment. But these items, since they're in the non-operating section up here, do not qualify for net of tax treatment. They're reported before tax, and they're reported in this non-operating section. All right. So that's unusual gains and losses. Here are the definitions of unusual in nature or infrequent. So you can take a look at that if you want to. All right. So here's an example. Xerox Corporation in 2010 had a restructuring charge. So first thing to think about, well, is this a multi-step income statement or is it a single-step income statement? Well, it's a single-step income statement, so we can't see that non-operating section. It's not differentiated from the operating stuff. So we kind of have to just look into each item to see if it's an operating item or a non-operating item. You find out there's restructuring here, and restructuring is pretty big, $483 million in 2010, which is about 6.7% of revenue. So this can be a big thing, and it's an unusual item, so it's affecting their bottom line. It's probably material. Their net income, right, is only $637 million. So without this charge, their net income is over $1 billion. But with it, it's down to 637. All right. So what does that mean? What does restructuring mean? Well, we can go to their notes. Whenever you're looking at this kind of thing, you want to learn about what the line items on your income statement or the balance sheet. You have to go to the notes. There's going to be tons of information here. And if you look at the notes, you can see they describe the restructuring charges. During 2010, we recorded $483 million in net restructuring and asset impairment charges, which included the following: $470 million of severance costs related to headcount reductions. Right, that's euphemism. They fired people. They fired about 9,000 employees. The costs associated with these actions applied about equally to North America and Europe, approximately 20% related to developing market countries. So they go on and talk about it a little more: lease terminations, losses associated with a Venezuelan subsidiary. So this is where you have to go if you want to learn about these unusual items. You got to go to the footnotes. So whenever you're looking at financial statements, you always want to go to the footnotes. Here's another example where there were restructuring charges. John Deere, this is an old example, 2008 financial statements. Believe it or not, there are restructuring charges here. It doesn't look like it. If you looked at this and you saw, again, single step income statement, it doesn't look like there's anything going on too bad here. But if you flip through to their notes, you'll actually find out that there were some restructuring charges under special items. This is Welland. They say that they closed this manufacturing facility in Ontario, and ended up with having restructuring charges, $98 million pre-tax, of which $49 million was recorded in the fourth quarter of 2008. They recognized them in cost of sales. So I don't know how they got away with putting them in cost of sales. Perhaps they argued that they were immaterial, but $98 million seems like it would be material here, given that I guess net income is $2 billion, but $98 million seems like it's still a material number. But they got buried in cost of sales. So one of the things you need to do is make sure when you're analyzing your financial statements in the future, you want to look for one-off events to see if you should be forecasting that same amount of net income next year, or if these one-off events are making up a lot of net income. So in this example, there are one-off events, and they're being buried in cost of sales, which you would think would be a recurring amount. So make sure you look at the footnotes when you read the financial statements. I think that's the moral of the story. So that's unusual gains and losses. The next one, discontinued operations. So discontinued operations, a company might eliminate part of their business if they can. We have discontinued operation when a company limits results of operations, the cash flows of a component, and there's no significant continuing involvement in that component. So one of the big things with discontinued operations is that you need to be able to segregate it from your normal business, from the rest of your business. So if you're getting rid of a section of your business and you can segregate that from the rest of your business, then it might qualify for discontinued operations. But if you can't easily eliminate that, you can't differentiate between the portion you're discontinuing and the portion you're keeping, it's not going to qualify for discontinued operations. Discontinued operations are important because they're reported net of tax, which means they get to be reported lower on the income statement. And a lot of times when people read the income statement, especially a multi-step income statement, they look at the top numbers and they think that they're going to be more likely to recur. So if you remember the multi-step income statement, it's sales minus cost of goods sold equals gross profit. That's at the very top. That is the main part of the business, right? If I'm a manufacturing business, for example, I'm Ford, I sell cars and I build cars. Sales are the sales of the cars. Cost of goods sold is the cost of making that car. So that's the main part of my business. That's how I generate money, and so that's what I think is going to be recurring. That's the most important part. It's the very top. At the very bottom are income taxes, and then finally discontinued operations. And since discontinued operations are a special section, very bottom, people don't think this is going to be a recurring event. You shouldn't have discontinued operations happening often. So, again, I think the feeling is that investors assign more attention to stuff at the top of the income statement rather than at the very bottom. So that's with discontinued operations, it's reported at the very bottom, net of tax, below income tax. So what constitutes an operation? The FASB in 2001 calls an operation a component, so something that could be included in discontinued operations. Component of an entity whose operations and cash flows can be clearly distinguished operationally and for financial reporting purposes from the rest of the entity. Here's an example. SoftSew Incorporation experiences losses with certain brands in its beauty care products group. They decide to remain in the beauty care business, but will discontinue the brands that experience losses. Is that a discontinued operation? Well, it's just the brands, right? So the brands don't necessarily mean that if you get rid of a brand, doesn't mean you can actually segregate that from the rest of the company. So I don't think that's a discontinued operation. You're still making the same products, you're just selling them under different brands. So it's hard to know what you should put in that discontinued operation. And then two, SoftSew decides to sell the beauty care product part of the business and will discontinue any continuing involvement in the product group after the sale. So in this case, I think it is a discontinued operation because it's a totally separable part of their company, and you can differentiate the cash flow from the rest of the company. So that's the discontinued operations. Here's another example. McCarthy Corporation had after-tax. This is sort of about how do we report discontinued operations. Well, McCarthy Corporation has after-tax income from continuing operations of $55 million in 2019. During 2019, it disposes of its restaurant division at a pre-tax loss of $270,000. Prior to disposal, the division operated at a pre-tax loss of $450,000 in 2019. There's a tax rate of 30%. We have to prepare a partial income statement. Well, so we know income from operations, from continuing operations, so not discontinued operations, is $55 million. Then we need to, below this, we need to report our discontinued operations. So again, income from continuing operations is after tax. So again, if you looked at this, income tax would be reported up here. You'd have income from continuing operations, which is an after-tax number. And then you'd have discontinued operations, which are all after tax. We have the loss from operations. We'd report that net of $135,000 tax. How do I get $135,000? Well, that's going to be the $450,000, which was their operating loss, times 30%. So 30% of their $450,000 loss is $135,000 tax, meaning that the operation loss on operations is $315,000. The other part of it is loss on disposal. They said that there was a disposal, a pre-tax loss on of disposal of $270,000. That's the $270,000. 30% of that should get you to $81,000 tax. The $270,000 minus the $81,000 should get you $189,000. That's the loss on disposal. So the total loss on discontinued operations is the sum of those two after-tax losses, $504,000. We would subtract that from income from continuing operations to get to net income. Okay, so that's how we report discontinued operations. It's at the very bottom. So you notice income taxes here. Income before taxes is here. And so we take net income, we rename it income from continuing operations, we report our discontinued operations below it, and we move net income down here as being the very bottom line. So that's discontinued operations, how it's reported, where it goes. It goes at the very bottom of the income statement, again, because it's supposed to be non-recurring and investors shouldn't weight it very much when they're considering the performance of the company this year. Here's another example, John Deere. Again, they have income from discontinued operations in 2006, in this example, of $240 million. And to learn about it, again, you need to go to the notes and you can read about their discontinued operations there. They sold a subsidiary, John Deere Health Incorporation, to United Healthcare for $512 million and recognized a gain on sale of $356 pre-tax or $223 million after tax. So they talk about that in a little more detail and how they get to the numbers. This $240 million that goes into the income statement. All right, so that's discontinued operations. Quick question about that, review question. If you have discontinued operations, they need to be reported separately in what? Both a single step or multi-step income statement, single step only, multi-step only, or neither single step nor a multi-step income statement? Well, the answer is both. It's always reported separately if we have discontinued operations. So the last item we need to discuss is non-controlling interest for this video lecture. Non-controlling interest occurs when there's a business combination. So when a company owns substantial interest in another company, generally over 50%, GAAP requires that financial statements of both companies be consolidated. And when we consolidate companies, we present all of the income as ours. So even though we may only acquire 51% of a company, we have to consolidate, but there's still 49% of a company that belongs to other shareholders. So, for example, YouTube was acquired by Google, and Google probably acquired 51% of YouTube. There's still 49% of YouTube that's owned by other shareholders, not Google. The non-controlling interest is a portion of equity or net assets, same thing. That's in a subsidiary that's not attributable to the parent company. So either equity, or we also present this as the portion of net income that's attributable to some other owner, the minority owners. So here's non-controlling interest as presented on an income statement. This is Poquito Industries. The non-controlling interest will be reported down at the very bottom of the income statement. So you have net income, and then we would subtract off the income allocated to minority interest, and then we have income allocated to the shareholders of Poquito. So, in the case that I brought up, YouTube and Google, Google owns 51% of YouTube. Some other owners own 49% of YouTube. So 49% of net income for YouTube is attributable to YouTube owners, not Google owners. And so we would represent that here at the very bottom of the income statement. All right, so it's an it's an allocation of net income to the non-controlling interest or minority interest. So I think that wraps it up for this video lecture. Next class, we'll talk about other reporting issue, these three things here in more detail. But for this lecture, I think we're all done with irregular income items. Thanks.